Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for October 12th, 2020. Please see our disclaimer for important information. In our conversation this week, as we inch closer to the election, it does appear, at least by some pundits, that we are gaining some clarity on who might win the election and what that might mean for markets and inflation, etc. We'll certainly spend a few minutes talking about that. Obviously, we're also inching towards the end of the year, and I think most of us are pretty glad to be done with 2020 for a lot of different reasons, not the least of which being the pandemic and the disruption in all of our collective lives. But so we'll talk about what the tea leaves read, and probably just spend more time kind of focusing on kind of this near-term expectation and what the markets seem to be reading into it. And I also, want to make sure that folks know that we have Charts of the Week as kind of a sister publication, if you will, to this, and it's available on our website and through our YouTube channel for BKA. But last week we had a good week. We had the Dow up 3.3%, the S&P 500 up 3.8%. NASDAQ was up 4.6%, and the Russell 2000 was up over 6%. Year to date, we've seen the S&P move about 7.6% higher. Dow Jones ended the week actually a little bit above the waterline, which is we've only seen that once before here this year. NASDAQ is up 29%. Again, technology stocks, the FANG stocks have led the way there. Small caps still somewhat challenged for the year. They're negative 1.8, 1.9. International stocks remain challenged, negative 6.2 for the year. And emerging markets are up slightly. And frankly, international markets and emerging markets have the best valuations out there, but they struggle with a catalyst right now. And as you'll see in the Charts of the Week discussion, if you have time to listen to that, you'll note that we've seen a true second wave in Europe for coronavirus infections, and that's going to have an adverse impact on the backdrop there. So looking at fixed income, the Barclays aggregate index is up about 6.5% for the year. And then if we look across the landscape here to commodities, crude prices were up for the week. They're still down about 33% for the year. Gold continues to kind of waffle around that 1900 level per ounce. Ended the week at 1919 per ounce, and gold ended the week, by the way, at $40.60 per barrel on WTI crude. Gold, for its part, is up about 26%. The dollar is down about 3.5%. And high yield continues to perform okay for the month. Spreads are down, so I mean the perception of risk has gone down a little bit, and high yield spreads are about 133 basis points year to date. A 10-year Treasury eked up a little bit. We saw perhaps some read through on inflation that ties back to this kind of perception that the election's becoming a little bit clearer, perhaps. 10-year Treasury rates were up about 7 basis points to 0.77%, and they're still down about 1.1 percentage points from the beginning of the year. So, I mean, the S&P had its best week since July. Fiscal stimulus remains kind of front of mind. We started the week after, on kind of a bad note when President Trump said that the negotiations were being ceased or halted, or if you will, and then there was rhetoric towards the end of the week that they might be restarted, and some hopes kind of got filtered back into the market. And in fact, even this morning, there's kind of conversation that the president might be willing to go somewhere close to 1.8 trillion, which has everybody's feathers ruffled, and is clearly an attempt to kind of buy some favoritism heading into the election. But So we had volatility, pre-market or pre-election volatility indices really continue to drop, which kind of, gives us a greater sense of conveys a greater sense of complacency. But the implied volatility for months after the election remains pretty elevated. So I think people are expecting a fair amount of chop coming there. Again, talking about the prospects of a Biden victory, which is seen supportive of higher yields, and especially given implied higher deficits and greater scope for fiscal spending and whatnot, that is helped to prop up interest rates somewhat. But from an economic standpoint, business sentiment is elevated, and the third quarter bounce has been a little bit stronger than expected. Trade deficit has widened significantly as the recovery in U.S. spending and production has led to a fairly big surge in imports. Goods and services shortfall hit about 67 billion in August, which is the most that we've seen in 12 years. Continuing claims are continuing to fall, which is a good sign, but initial claims remain kind of frustratingly high, if you will. We had about 840,000 initial claims last week, and that remains quite elevated relative to where we were before the pandemic. Purchasing Manager Index really kind of indicated that while the global economy is continuing to recover, economic activity in most countries remains well below the pre-COVID levels, and the global composite PMI was at 52.1 last month, and that's down slightly from a month ago. And the economy continues to recover from its bottom there in April, but we know that it's going to take a long while for a lot of these economies to recover. So, and then the other item, going back to the U.S., the Institute for Supply Management, the Services Index. Again, services represent a much greater percent of our economy than does manufacturing, but the Services Index inched up to about 57.8, and that's actually above early 2020 levels. So that's interesting and positive. At the same time, services we know has been down, and manufacturing's been slightly up just because of the goods trade and whatnot. So, but looking at different things, we've seen a little bit of leadership change, if you will, on the in the market. Now we know that the FANG stocks really drove a lot of this recovery during the summer in the index. But interestingly enough, the equal weighted S&P 500 index is up 13% over the past 3 months versus 10% for the overall index, which is capitalization weighted. So again, the broader index, which represents the majority of all index constituents, actually did better than those stocks at the very top. So that's actually positive to see. I've really personally struggled with the fact that we've had some mixed leadership for a long time in this recovery. But and then over a 10-day period, last 10-day period, we had advancing stocks outnumber decliners by more than 2 to 1, and that doesn't happen very often. So we've had a lot of buying in the market, which is really big. And then on the interest rate side, I mentioned that Treasury rates were up a little bit. The 30-year hit a 4-month high of around almost 1.57%. And interestingly enough, we haven't seen that translate into any higher 30-year fixed mortgages, which are typically kind of benchmarked to the 10-year. They continue to hover around 3%, which is just slightly below the prime rate of 3.25%. But we've had a slight rise in inflation expectations over a 10-year period. Again, this is long-term inflation expectations. I would probably tend to expect perhaps more disinflation over the near term, particularly as we head into next year. But Then we continue to see large money flows into fixed income funds, and in fact, almost a record level of flows into fixed income funds, almost $30 billion last week. And equity funds, which have seen outflows, actually had inflows, but perhaps one fifth of what we've seen into bond funds this past week. So very interesting developments there. That a lot of this equity gain is coming kind of tangentially and not from retail investors, not as much from retail. But having said that, I mean, U.S. and global economies have experienced V-shaped kind of rebounds coming out of the shutdowns. And then, we're going to get some data on the third quarter real GDP number coming up here in a couple of weeks. We expect that number to be, somewhere 25 to 30%. But we expect that number to go back down to, perhaps 4, 5, and if we're really, really lucky, maybe 6% in the fourth quarter, which on an annualized basis is extremely encouraging, but it's the recoil effect of having such a large drop and then a large gain, and then we're kind of going to normalize in that low positive single-digit category is what it appears right now. But the Fed continues to want more fiscal stimulus to dovetail with its continuing asset purchases and its monetary stimulus into the market, because we've got to have both. I mentioned to you also that with Treasury yields, I mean, there's a thought that inflation might be on the horizon here. We've had really huge Treasury auctions, a lot of Treasury supply being put on the market, and then obviously this increasing feeling perhaps that we're going to have a Democratic sweep. But in any case, we've seen a large drop in government spending at a lot of the state, local levels. We've seen a lot of hiring evaporate at those levels as well, and we know that there's going to be a drag in spending from the government sector overall. And the household sector, or neither the household sector nor the business sector, are really healthy enough to offset that kind of drag right now. And so we're going to need a kind of a fiscal reconciliation, if you will, over the next several years. But we've got to basically ensure private sector growth at whatever means we can achieve. And right now there's seems to be very little political consensus, except for the desire to spend simply to win election plaudits from their constituents. But we don't save enough. We're importing more, and we've got low rates. So our dollars less, our treasuries are less appealing than they have been in the past. But U.S. still is the best game in town because Europe has negative rates, and China is really struggling over its currency right now and trying to control that. But so looking at the election, obviously there's been some change in the polls. I'm not going to go into the nuts and bolts of why those poll numbers have increased. I'm sure all of you have been watching TV and probably saw the debates, but they tend to indicate a increasing chance for a Democratic blue wave, if you will. So there's a really kind of a mixed impact there. There's the possibility of corporate tax rates rising, and probably, and who knows what the temperament is going to be towards China. We know that the rhetoric is really bad right now. We know that both sides are, there's unanimity across the board on this animosity towards China right now. And so, even though there might be some hope that a Democratic sweep might lead to a better relations there, I'm not so sure about that. But certainly a push for more stimulus and spending, I think, would be expected out of that. So if you increase the corporate tax rate from 21 to 28%. That would probably reverse the 10 to 15% earnings gain that we got when the rate was dropped back in late 2017 and for the 2018 tax year. But however, if you look at dividend and capital gains rates, and there's increasing rhetoric that you might change those. Right now they're 23.8%. Now, if they move it up to the top marginal rate and make that 43.4%, then you've got to have a really dramatic rise, like almost a 50% rise in corporate profits to kind of maintain that after-tax rate of return from owning stocks. And so as a result, you're seeing a little bit of merger activity picking up ahead of the election. And you've got rotation in certain areas where the people are beginning to expect and anticipate a Biden victory, renewable, clean energy, so on and so forth. So again, that's some of the machinations going on there. But I guess what we're seeing kind of elsewhere is a rise in caseloads. I mean, that we've got the chart in that our COVID tracker for the week. Increased mobility is leading to a surge in infections, but the other thing that we're monitoring that's of real importance here is the rise in permanent layoffs. And the fact that we have kind of sputtering in our recovery globally. And this comes despite a huge monetary support. I think that until we get that vaccine, and I think until we get it mass delivered or mass dispensed, if you will, I think equity markets may continue to or may struggle to move markedly higher from here. But we know that the political backdrop is going to remain volatile. We know that we're looking at the small business sector, and permanent closures continue to pose a risk overall, not only to employment, which half of our employment goes to small business, but Europe. I think we've already talked about the issues going on overseas, but the longer that we have restrictions on economic activity and mobility, I think the greater odds of of more permanent layoffs and perhaps some adverse impacts on consumption. And we certainly have had a lot of optimism in the markets to date because there are hopes for better profits, but I think we're at kind of a juncture now where we've seen a lot of the heavy lifting being done, and the incremental gains from here are going to be tougher to come by, I think. And so it's going to depend on some of these things kind of working themselves out: a fiscal stimulus, better health out of the small business sector, some continued or some improvements in the labor front. And whatnot there, but let's see, everything else. So just a couple of things that I think I wanted to highlight that kind of what the future looks like. I think I mentioned that the expectation for fourth quarter GDP is probably looking closer to like 5%. If we look at longer term, and we look at labor, and we look at some other things, it looks like unemployment, we should probably expect, perhaps 4% there, and inflation by the end of really at least 2022 and into 2023 of like 2%. And we just don't know because of the virus right now what that trajectory is going to look like. But, we know that the pace of economic improvement has moderated since the early part of the summer, and if we can't stem the flow of permanent job losses, that's going to have an impact on consumption. And so it really places a premium on the policy intervention like we've been talking about. But the risks of doing too little are much, much greater than overdoing it. We can obviously absorb more funds into the market. Perhaps that leads to more inflation, but the risk of not doing enough at a point where we can see very clearly the impact on incomes, is particularly on the lower socioeconomic layers, that we would have a rise. If we don't do enough, we're going to have a rise in household insolvencies and bankruptcy at the business level. So we've clearly got to get this right in order to prevent that type of calamity. And continuing on payrolls, we're at an unemployment rate of 7.9. That's down from 14.7, and we've recovered half the jobs that we lost in the pandemic, which is about 22 million. But we know that, again, the burdens are following on the lower socioeconomic levels. Job losses more heavily, felt in lower wage categories. And we know that employment, in the bottom quartile is far below its February level. I mean, much more so than, people in the top three quartiles. And we know that it's had an impact on certain ethnic and minority groups as well. And so, you can just see that if the degree to which that persists, we could continue to see more social unrest and kind of the tangential things that happen when you have more social unrest. So I would expect to see that. Now, having said that, we're getting some really good feedback from C-level executives that they're going to be spending more money on more capital, increasing their capital spending, I should say. And that's a positive thing. That shows a lot of confidence. We know the surveys, both the CFO and the CEO surveys, have been actually fairly positive throughout all this. And we know consumers are a little less optimistic perhaps, but certainly business executives are a lot more steadfast in their plans to increase spending. And, we know that when they do that, that they're reinvesting dollars into their businesses, that's going to help to create jobs and help to stimulate the economy beyond what we can hope the federal government will step in and inject into the economy. But I guess just to recap here before we depart today, the tea leaves are kind of increasingly suggesting a Democratic win and perhaps even a Democratic sweep. With that, we know that the first thing we should expect is a corporate tax rate increase of roughly 7 percentage points to around 28%, and we would expect at least the rhetoric to begin with regard to increased taxation on dividend and capital gains. So that's going to be important to potentially plan for, and we'll have lots of lead time to know if that's going to happen. And chances are that that you may not get something retroactively, but those would be the two areas amongst a lot of different other types of taxation moves that could be introduced. But those are the two likely ones to get through, especially at a time where we're in kind of this tepid recovery situation. But I think the international markets are going to be challenged until they get through the second wave. Obviously, we have the risk. We almost had wave 1B in July, and the question will be, how well are we going to be prepared during flu season? So get your flu shot to weathering our own true second wave if it is. And even though we're going to have lots of conversation about new therapies and vaccines, I think that it's not realistic to think that we're going to have a mass inoculation event until at least probably the second quarter of next year. So we should all be prepared for that, be prepared for a little bit more volatility after the election. But that doesn't mean that we should just go, do a lot of major surgery on portfolios now that I think, over the long term, clearly long-term financial plans are built to weather these types of choppy times. So I wouldn't recommend that, folks go out and make wholesale changes in their portfolio allocation. But in any case, we'll continue to follow the data, follow the news flow, and continue to report back to you in as much as we can. I hope you have a safe week, a productive week, and hope to see you back here again next week for our Market Minutes. At the information provided, we'd love to hear from you, and have a great week, and we'll talk to you soon.